Welcome to the Credit Clubhouse, where we take a weekly dive into the world of credit markets, alternative finance, and everything in between. Don't forget to follow the show, rate us, write a review, and share with friends. We're always open to guest or show ideas, so please feel free to reach out anytime. Just todd.anderson@dealcatalyst.io. I encourage you to check out the remainder of Deal Catalyst's 2026 calendar, including ABF 2026, Fund Finance West, moving to Vegas for the first time, and GPLP Secondaries, which is a new addition to the schedule. Listeners can get up to 10% off any ticket to any conference by using the promo code CREDIT at checkout. And now, on to our next episode. This episode is brought to you by Cardo AI, the operating system for asset-based finance and private credit. These markets still run on spreadsheets and siloed systems. Cardo AI brings everything into one system. The data, the structuring, the borrowing bases and waterfalls, the cash flow modeling and simulations, and the investor reporting. That's front office to back office, all in one place. Today, more than 700 facilities and $150 billion run on Cardo AI. The world's most sophisticated investors and lenders use Cardo AI, equipping their teams with a level of control and intelligence that legacy tools simply cannot match. See it for yourself. Talk to the experts at cardoai.com. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Dianna Carr-Coletta, Managing Director, Middle Market Direct Lending at PGIM. Dianna, thank you very much for the time. It's a pleasure to see you again, and I'm looking forward to the conversation.
Me too. Thanks, Todd. Great to be here.
So, PGIM, obviously, large, well-known brands. If we think about, private credit and the history of PGIM in the space, obviously you were investing long before it was an asset class to the extent it is today. What did private credit look like when you guys first started jumping into the space?
Yeah, I love to go back in time and think about, I started my career a long time ago in commercial banking. And that's where everyone was thinking about, okay, where do you go if you need a loan? You go to a commercial bank, especially if you're a business. Yeah. And then I had the opportunity to join an insurance company, and I was like, an insurance company? Like, what do they do? Like, what are private placements? What does that mean, right? And so it's way back then, right, in 2000 when I came over to the private credit side, and I remember thinking, an insurance company, that's kind of boring. And now, flash forward, right? Private credit is all the rage that you talk about. So a long time ago, right? Like, private credit was primarily being done by insurance companies to help them match their liabilities to help match assets with their liabilities. And then you also had some, like I call them, like the OGs, right? That were there, like the likes of GE Capital, Monroe, and all of those guys. They've been doing it for quite some long time, but it was a relatively small part of the overall market at that point. And as you said, it didn't really explode until a little bit later.
So if we think about, obviously, the where it is today, and many people consider it this post-GFC phenomenon, but obviously, as you just alluded to, it's existed long before then. What are some of the misconceptions about the history of the asset class? Is it more risky than traditional lending? Maybe go into a little bit of how it's perceived.
Yeah. There are misperceptions, and I always bring it back to, essentially, it is, commercial banking with a little less, regulatory restrictions that come with it. And because of the less of the regulatory restrictions, it doesn't mean it's riskier, right? The regulatory restrictions that come for commercial banks really has a lot to do with the fact that they have short-term liabilities, right? Deposits for customers. and they're matching them with loans. And so you need to make sure that, those loans are good loans, senior secured loans, et cetera. When you go into the private credit and direct lending specifically, you're matching it a little bit with different type of liabilities. And so as a result of that, and you don't have that immediate liquidity need, right, you can put the money to work and keep to work a little bit longer, right? You can get access to that interest rate and to the flows of money that come from that current income that comes off of that, and the return that you get from that without having to amortize it. And as a result of that, you're looking at a same risk profile that you would be doing in a commercial bank, but you may be doing it in getting your money back a little longer, right? Keeping it to work longer. And that's, again, to match asset and liabilities. So it's not riskier, and you're getting paid for that risk in terms of having a longer maturity or not getting your principal back as quickly as it is. But I don't necessarily think it's riskier. There are definitely platforms and strategies where you would say, all right, is that a riskier strategy or a riskier platform? But that's a specific strategy to a platform manager as opposed to the overall asset class.
So if we jump into a little bit more about, origination, when we had first met a couple weeks ago, you were telling me this great story, and I'd love for the audience to hear it about, kind of that differentiator that PGIM has, which is, kind of operating like a bank in terms of your network and building a regional distribution. But tell us a little bit about that story, and ultimately, how does that still influence how you guys operate today?
Yeah. So I always take a walk back in time, right? And I talked about private placements, right? And that concept of doing investment grade fixed rate bonds that are private. And that was what insurance companies were doing for years, right? That matched their liabilities. A long time ago, PGIM decided that we weren't just going to get that type of flow coming from investment banks, from the likes of a JP Morgan, a B of A, a Barclays, all of that, that we could actually set up a regional network that would mimic a commercial bank, and we could call directly on companies and develop that relationship with those companies. And in doing so, it would allow us a couple of things. One, it would allow us unique kind of deal flow for our investors. And at the time, the majority of those investors were insurance companies, with Prudential being the largest. So you get unique names and unique deal flow coming in. But it would also allow you to get, quote unquote, bigger allocations, right? If you were coming through a syndication, you would be allocated a small amount. You bid 150 million, you'd get maybe cut back to 25. This way you could do the full 150 million. And the final thing, which I think is most important, is you would actually get direct access to the company before you did your underwriting. And in the traditional sense, you would always just get a pretty book across your desk, and you do some desktop diligence, and you would bid on that investment opportunity. This way, we had developed relationships with those companies for years before we would actually do a transaction with them. So that makes a difference, right? Having that information transparency and that differentiator, right, in terms of what you're providing your investors. So we rolled that out, and we now have 15 offices globally that is implementing that type of strategy, calling directly on companies. Now, what we've done is we've layered in different types of capital that we can provide to those companies, right? Originally, it was private placements. Then we layered in mezzanine. And now we've layered in direct lending. And why that's really unique, right, is the majority of the direct lending market today, right, is with sponsor-backed companies, right? Yep. That's not what we're doing in our markets, right? What we're looking for is we're able to provide direct lending or a different type of lending to those companies where they've traditionally just gotten their money from commercial banks. And so just like we were able to bring when we were doing private placements or fixed rate debt and complementing what their banks were bringing to the table, to their balance sheet, now what we're doing is we're complementing what their banks bring to the balance sheet, in that we're providing them with that longer term debt. It's floating rate, so they like that better because it's inflation hedged for them, right? It floats and it's not fixed rate. That's a good aspect of it. but we're bringing it with the exact same approach, and that is relationship approach. It's your favorite commercial banker, take a different pocket of money from an institution, and we're providing it in the same way where they know us, they're familiar with us, we've been calling on them for years. And that's a really, differentiator.
When you think about how, big and abundant capital has become, how important is that direct relationship? If I'm thinking of it as a borrower versus, I can go, you mentioned a couple of different other options, but if I can go to a PGIM, I know the person I'm dealing with. There's been an established relationship for a long time. How meaningful and different does that make it, maybe compared to some of the other options? Especially as capital has kind of become, significantly more abundant across private markets.
Yeah, I think you got to think of it in two different segments, right? You can think of it in the sponsor world, the private equity sponsor world, right? I mean, they're very familiar with all the different types of capital that are out there. And you do develop relationships with sponsors over time, and there's repeat business. And once you've had the opportunity to work with that sponsor and the sponsor work with you, they like the fact that you have a precedent document and it's easy to utilize you. If you take that into a privately held business, like a family-owned business, right? All they've ever really known is their commercial banker. They're local, they're boots on the ground, they've been calling on them for years. And if something goes sideways or they go through a cycle, they want to know that that bank is going to be there for them. And they really want to know if that relationship manager is going to be there for them. So the importance is, if you're going to bring a different type of capital that the company will benefit from, and again, not replace their commercial bank, but complement what their commercial bank brings to them, you have to do it, and you have to meet them where they are, right? And you have to meet them in that relationship-based environment. A lot of companies will rely on an intermediary to come in and try to place that type of debt if they're looking for direct lending. This could be the first time that they're meeting the individual on the other side of the call with them. And so you're trying to build that trust. If you've actually been calling on that company for a very long time, which is the case in our business, right? Because private equity funds, they need this capital all the time. They're doing LBOs, they're doing add-ons, they're constantly utilizing direct lending. When you're talking about privately held businesses, it has to be a reason. It's very episodic, right? It's going to be an acquisition, it's going to be a shareholder kind of distribution or buyout, or it's going to be a large capital expansion. So it happens over time, and it doesn't happen back to back to back to back. So as a result of that, sometimes you're calling on these companies for 5-10 years before you actually do anything with them, right? But during that time, you're building that trust, and that's what that family-owned business wants, right? They want to trust the other person on the other side and view them as a financial partner.
How has technology changed the way that you're able to source and evaluate opportunities? And a secondary question to that is, obviously we talked about the abundance of capital a minute ago. Has that made direct origination more valuable, more difficult?
So in terms of technology, to answer that one first, I think technology has helped us identify, companies. It also helps us with better diligence when we're underwriting, and on that, I call it a desktop diligence. Yeah. Technology has made that a little more efficient for us, helps us identify targets better. And so maybe there's a company that we didn't know about that was in our markets where, they're calling boots on the ground. And to be clear, I want to emphasize, when I'm talking about being in the markets and being like a commercial bank, right? I spent years in the Wisconsin market, right? Driving around Wisconsin, calling on all the companies in Wisconsin. And for those of you that don't know Wisconsin, it's a pretty big state, right? You're only about an hour and a half to Milwaukee, but you got to go all the way up to Green Bay and then, up to Shawnee. So you've got all of these other places that are there, and you're driving around calling on companies there. So you do have boots on the ground are there. And I got to say, technology cannot replace that, right? That walking through the streets of a local town, understanding the local economy, knowing the local people, kind of that 3D type of connection as opposed to this 2D that we're having right here, Todd.
Yeah.
That nothing can replace that, and technology will never replace that. It will make you more efficient, but when it comes to relationship type of investing in the non-sponsored space, that's important. And I do think you need it in the sponsor space as well. So when we talk about the flux of capital that has come into this space, we're really talking about the flux of capital has been in that sponsor backed, in that PE backed. That's where the majority of the direct lending gets done.
Yep.
When I'm talking about the non-sponsored, there's a lot of white space there. There are not a lot of companies that are utilizing this type of institutional capital in the middle market. And I think that's where, if you have this network that we've built out through a huge platform that we can leverage, that's what's going to give us kind of a first mover advantage as privately held businesses begin to adopt this type of capital more and more in their structure, just like they did when they adopted fixed rate private placement.
So if we step back a little bit in terms of the evolution of direct lending, obviously post GFC, it's exploded even more. Has the current iteration of direct lending been truly tested? Like that, obviously pre-GFC, there was a big credit cycle there. But what about post-GFC? In this new iteration of direct lending, have we been fully tested yet?
Yeah, in my view, I don't think we've been fully tested. We did go through COVID, which in my view was totally different than what you saw in the GFC. And the difference in COVID was that there was so much liquidity that went into the market that it held companies up. Now, where you are seeing this being tested is the vintage, that 2020, 21, and early 2022 vintages. That vintage of loan is being tested. So while we went through COVID, we didn't have the big drop off or the big, declines in performance like we saw in the GFC. After that rolled off, that's where you started to see kind of the difficulties in that vintage. So I would say, look hard at that vintage. We got to watch how that vintage performs. And then I think we can finally say, okay, we've been tested through that. So I do think that there is a vintage in this that's going through it, but that was a small part of the vintage. I think if you look back in history and those that have been in operations in the late 90s, in the 2000s, and went through the GFC, I think that speaks to the overall asset class and, how well it can withstand kind of these downturns. Because at the end of the day, this is senior secured debt that is supporting private equity backed businesses. And that's the vast majority of what it is. So if you're comfortable with your private equity holdings, you should be comfortable with your private debt holdings, right? Because they're financing the same company.
Obviously, you've referenced a couple of times the sponsor backed versus non-sponsored. When you think about, and you guys do both, I believe, when you think about the risk return of the two markets, how do you compare them? And, ultimately, where is the best value today, or does it just depend on what the end investor is looking for?
Yeah. So the best value is all relative, right? So is one risky? There's a perception that one is riskier than the other. And a lot of folks think that, hey, if I have a private equity backed company, that's great because the private equity, they're great operators. They've got money to bring to the table. And so that's money good, right? So they'll think that's lower risk. So they naturally look at me when I'm going around talking about our non-sponsored origination, privately held businesses that are not private equity backed. And they look at me and they go, well, what's the incremental spread that you're getting on those companies? Because they're naturally riskier. And I try to point out that it's two different types of risks, right? So let's start with the private equity businesses, the private equity owned businesses. Indeed, what do you get with that? You get equity that they bring to the table. You get a market valuation because you know what they're paying for the company when they're undertaking, the LBO and they're doing it. And you are often bringing, professionalized management to maybe the smaller end of the middle market or even in the lower middle market. You're bringing that professionalized management. Often those companies may or may not have boards, so you're bringing board kind of a representation. So you're getting all that through the private equity fund. What you're giving up is part of what private equity funds are trying to do is they're looking at their sources of capital and saying, how much leverage can I put in? Rather saying, how much equity do I need to put in, right? And the more leverage I can put in, the better that my returns can be. Now, where they're really going to get their returns is they're going to get it through multiple expansion. They're going to get it through EBITDA and growth. They're going to get it through rolling up. So recognize in value creation, right? That's what all the private equity guys are talking about, and gals, is the value creation. That's what you're getting. But you're going to get more leverage, definitely, than what you're going to see in other areas. They want looser covenants. So they want to be like, hey, just go give me the money, lender, and then just go sit away because I've got this, I've got the expertise, I've got the money. So you have looser covenants. And then you've got looser terms in general, meaning you've got baskets where you can take on incremental debt. You've got baskets where you can do restricted payments and dividends out. So you're getting that. So we're willing to give that up because they're bringing the cash equity to the table. We're getting a valuation. So direct lenders are willing to do that. On the non-sponsored side, you don't have that, right? You don't have that cash equity coming to the table. You have a privately held business where the family, generally their net worth is tied up in that business. So what do you get with that? Well, what you get is instead of wanting to max out leverage, they want to have the least amount of leverage possible to achieve their strategic goals. So you tend to have leverage that's inside of what you would see in a sponsored portfolio. And that's because these individuals have to sit around the dining room table around the holidays and talk to, Aunt Betty and Uncle Ed and say, the company is in good shape. I haven't leveraged it to the hilt. They have to know that they're employing company people that are in their communities, right? And they want to make sure that their company is going to be there. So you have lower leverage. The other benefit you have is you have better terms, like you have tighter terms. And that goes back to what they're used to, right? They're used to the commercial bank terms, which have a lot of terms in there. It's not just one covenant. It's a lot of maintenance covenants, especially in the middle market. So they're used to that. And what that allows you to do is if you have the covenants, what are covenants meant to achieve? They're not meant to be gotcha, right? Like, oh, gotcha. What they're meant to achieve is to have you sit at the table and highlight, hey, we may be going through a cycle. And let's make sure that we're at the table and talking about it and doing what we need to do before too much value is lost, right? And so that's the benefit of those covenants. And honestly, those individuals at those companies, they want the same thing, right? They don't want the covenant set so tight that they have to come to you for everything, but they want to set it tight that if they really do go through a cycle and we're seeing, maybe a little bit of liquidity is kind of get a little tight, a covenant goes off before your liquidity gets too tight. So to me, you get lower leverage, better covenants, but you don't have a market valuation. So you're just looking at comps and estimating what that would be. And you don't necessarily have that cash equity that's going to come in, but you have lower leverage. So on a risk-adjusted leverage profile, you're getting a lower risk-adjusted leverage, right? Because you're getting the same price. Over here, you're getting the same price, but you're giving up, kind of those covenants. So it may be a little bit longer before you're invoiced, or it may even be there's a liquidity issue before your covenants even go off. And then you're relying on that private equity sponsor, to help out with that liquidity issue and put money in.
Is there any, a couple of follow-ups come to mind. One is there any particular risks that are sometimes overlooked in the sponsor-backed space that are maybe assumed that because of the private equity shop and the professionalization that you take into account when doing a deal like that, you're like, all right, well, this is taken care of, but maybe is somewhat overlooked?
Yeah. So in the sponsor world, right, I think it's always important to look at the vintage and where the sponsor is, that private equity sponsor, where they are investing in that vintage, right? So when I talk about it, like, do they have capital left in their fund to actually bring additional liquidity if it's needed? And that can be overlooked. Or maybe a dividend recap. So you're giving, the company has performed, and as you know, private equity sponsors have had to hold businesses longer in the current environment.
Yep.
And so as a result of that, they're trying to get the return of capital to their LPs. So what they're coming to the direct lenders for is saying, hey, this company's performed, we've delevered, that's great. Can we take a dividend out? And so you're like, okay, I'll give you a dividend. Well, you need to look at how much money have they taken out? Have they taken all of their money plus a return off the table? Because if the company then gets in business, they may not be as willing to put in equity if needed. They'll be like, no, we're done. Now there'll be, the relationship side of that is the sponsor will be, hey, I will consensually give you the company. We won't have to go through bankruptcy, et cetera. So that's where the relationship comes in there with the sponsor, but they no longer have that cash to bring in to survive. So then you could end up taking over that company, even though it's private equity owned. And I think that I know a lot of the direct lenders like that are investing in that are thinking about it. I don't necessarily think investors are always thinking about it that way and think that that's a risk with a private equity sponsor backed company.
And then before we jump into a little bit more about the white space and non-sponsored, are the business owners today a bit more savvy, better educated on, say, direct lending and this type of capital than, say, obviously 20, 25 years ago when some of this first started? Or are first-time business owners still a first-time business owner and maybe are still learning through some of that? Like, has the education amongst the non-sponsored increased over the last 20, 25 years, just generally speaking? Like, are they coming to the table a bit more prepared?
Yeah, I would say no.
Okay.
I think it's still in its infancy because if you think about this space, right, it's post-GFC, so you've got 2009, but it really ballooned in, 13, 14, 15. But at that time, all of it, almost all of it, was to sponsor backed, right? So it isn't until recently where advisors are talking to these privately held businesses when they have a capital raise need and saying, hey, there's something else that's out there that's different than a bank that necessarily hasn't been available to you in the past, right? Because they've always thought about insurance company debt being only fixed rate. And again, there's more than insurance companies providing direct lending, but that's a part of it. So
Yeah.
I think there's always been a little bit of a knowledge of you can get money from an insurance company, but it's fixed rate. Now we've got the floating rate capabilities and actually the ability to go down to that double B, single B type of floating rate. And so their advisors are saying, this is another option for you. And so they are educating the privately held businesses on this type of capital. So I think the adoption curve is going to improve, but it's going to take a while. And that is why you still see the market so heavily weighted towards, private equity backed transactions, just because of that dynamic.
Clearly you referenced earlier the white space opportunity. What, are there segments that are ultimately that still remain pretty under penetrated by private credit managers? Maybe it's by sector or size of company that might be close to being middle market.
Yeah. Yeah. Well, first I'll start with for in terms of private credit and companies, right? I'm talking about the middle market, but PGIM spans all the markets, right? It has large and upper market in terms of private credit. We've got middle market direct lending, which we define as 25 to 75 million of EBITDA. People have different views on what middle market is. And then we also have a relationship with our sister company, DeerPath, which does lower middle market. That is a sponsor-backed deal, that is a sponsor-backed strategy only. They're not doing non-sponsored there. But when you think about the opportunity set that is specifically in the middle market, right? In the US alone, there's roughly 200,000 companies that are in that defined space that I said that. 200,000 privately held businesses that are 20 to 75 million of EBITDA.
Still a lot.
That's a lot, right? How many of those are owned by private equity funds? Less than 10%.
Wow.
So that's your white space, right?
Yeah.
Now, not every one of those companies is going to need direct lending right now. Remember, I talked about the sales cycle, right? It's got to be episodic. But that is your, let's just use the word that everyone uses, TAM, right? That's your TAM that's out there. And that's just in the US, right? Yeah. Think about all these businesses that are in Europe and in the UK. And this is what drives the economy, right? Those businesses are what drive the economy. And you're definitely also seeing, more and more companies not go private or not go public longer before they go public. You look at, we're talking about it today, and SpaceX is doing going public, but it's been private for so much longer than what companies used to be private to public. Yeah. So it is this middle market kind of growth that's the engine of the economy. So I think there's a huge opportunity there, but it comes back to what your question was before. We need to educate these companies, get them comfortable with this type of capital, and those that have that relationship type of approach or have the network like we do, I think we're at an advantage. I think we'll, over the long term, we'll win, just like we were able to win in the private placement world.
Where are the biggest challenges today? Is it sourcing, underwriting, relationship management, a combination of the three altogether?
Yeah, I think it is. I'd add terms, right, as part of it. So origination is very hard. And so first of all, origination on the sponsored side, very, very difficult, very, very competitive, right? Yeah. Despite what you've heard, after, the software kind of SaaS apocalypse, you really have not seen a backup in other segments of the private credit in the sponsor side. So it's very, very competitive. So you've got to have a really big funnel with a lot of different deals coming in. We look at in our funnel, we close, less than 7% of the deals that we see that come into our funnel. So you've got to have a really big funnel that's there. But the origination on the non-sponsor side is really, really difficult because you're either relying on an investment bank to bring it to you, right, an intermediary, or you're out there calling on the company. And like I said, it's about that gestation period. Like, when do they have the need? When do they need you? So you have to make sure that you've got, a network that has enough spread out of it that you can really leverage the expenses that go into that network. Now, the other thing I will talk about is underwriting. I think that everyone has capabilities and we have the capacity to do that. And I think with everything that we're seeing in technology, that helps us improve our capacity to underwrite. So I don't think a bottleneck is necessarily there. But another part is just terms. Like, you've seen terms become much more eroded. And so you have to make a decision as a lender to say, am I going to accept these terms for, this type of pricing, or should I walk away from a deal? Do I really, really think that, that if I don't have this covenant or this term, am I at risk of losing money? And let's be clear, no covenant can offset underwriting a bad company, right? Or a company that's committing fraud. But so it all starts with credit. So you've got to start with the credit. But we're not perfect, right? Like, we're senior secured, but no one's made a perfect call on every company. And so the covenants can protect you if you're seeing it start to spiral down and get you invoice again before the value is too much eroded.
The LP side of the equation, when you tell them that story, the 200,000 businesses, I mean, are they just teaming to be like, hey, we'll give you more capital. How do we get more invested in this? How do they think about the white space in the non-sponsored space versus, kind of what they're used to in the sponsored space?
I think what they do love is they love the diversification, right? I mean, it all starts with diversification of names that's in your portfolio. So they're like, oh, wait a minute, I can get names that are not in any other of my private credit portfolio, because basically you're sole, or the sole lender in this non-sponsored deal. And then they start to think in the future, saying, oh, wait a minute, we all talk about there's too much money chasing too few deals, but there is this whole other white space for the non-sponsors. So they start to think that's really good. Now, you need to talk them through that risk profile that we talked about earlier, right? Is it riskier? Is it not? What do you like about it? You also need to talk them through the difference in underwriting, the two different types of debt. For non-sponsors, you definitely underwrite a little bit differently. It's a different underwriting process than what you're doing on the sponsored side. But yes, they would love to have more of that. But you always have to caution them and say, it's a growing market. Yes, I would love to have a 50-50 split. I'd love to have 50% with sponsored and 50% non-sponsored. And that would be great diversification within my portfolio in terms of names for you, different types of businesses, leverage profiles. But, right, I've got to get that adoption curve going a little bit more. And it's going to come, but it's going to take a few years. So I say, and the other thing you fight against is, in terms of that adoption curve, is when the PE-backed and the sponsor community really starts at it again, and M&A really increases, right? That's going to dominate private credit again. So you see these kind of ebbs and flows. But over time, I do think that, when we're talking to our LPs, we say, yes, this can be a bigger part of your portfolio. And it should be a part of your portfolio because it's providing name diversification.
We've referenced it a couple of times throughout the episode about obviously the abundance of capital coming in, competition increasing. When you think about the core middle market, and obviously that's so very much attractive to where you guys sit, and you've defined it as 25 to 75 million of EBITDA. How has competition evolved in that space compared to, say, the upper markets? And have you seen kind of terms and things shift as capital has increased into this area of the market, at least?
Yeah, so I think there's a lot that plays into that because it all comes down to getting capital to work, right? And how much capital can you get to work? So in the middle market, by definition, right, you're dealing with a smaller cap stack. Yep. So when you look at the bigger funds that are in the up market, right, to them, 80, 100, 125 million, that may not be worth, the juice may not be worth the squeeze when it comes to that. But in periods of very, very slow M&A activity in the sponsor world or other areas where you can put money to work, you may see some of the bigger guys coming down. When that happens, you'll see some spread compression and you'll definitely see terms compression. And that's when you need to make a decision, am I going to chase that deal or not? But often it's kind of like it's not big enough for it to chase. In the middle market, the reason we like the middle market is because it does have covenants, right? There is, majority of the deals in the middle market have real covenants. They're not what called cov light, right? Which you see a lot in the BSL space and also in the upmarket space.
Has that started to come down or not at all?
It's interesting. So I was looking at a deal the other day, and it's a smaller business, kind of on the lower end of the middle market, and the sponsor is requesting, right, to have a covenant deal until it gets to a certain size of EBITDA, which is still on the lower end of the middle market, and then go cov light. So you're seeing sponsors ask for this. Sometimes it's getting done, sometimes it's not. It's not getting done in our portfolio, but sometimes it's getting done because people need to deploy capital, and they really trust the sponsor, right? And there's nothing wrong with that. That's just a different type of strategy. So I do see it creeping in occasionally. But what I also like is in the middle market, you tend to have stickier pricing. It doesn't move as much. It's not as fast at moving relative to, sometimes what you see in the up market having to move because the BSL moves very quickly because it's traded, right? And so they've got to move a little more quickly or else they'll lose it to the BSL market, and they want to get that 350 million to work. So, I like the opportunity set in the middle market. I think it's a great place where we can ensure that we are underwriting senior secured debt. Now, what has creeped into the middle market is this concept of PIK, right? PIK toggles. And, can you underwrite a deal and allow the company to choose that they don't have to pay their interest in cash, that they can pay it, in kind, because they'd like to reinvest that cash in the company for growth. And those are mostly sponsor-backed deals. You haven't seen those in non-sponsored deals. We don't underwrite any PIK up front. It's just, our philosophy that senior secured debt should be cash pay. So that's how we utilize it. But you have seen that come into the middle market. And again, it's because it's backed by a sponsor. And so the lender is getting comfortable with the sponsor that, that this is a good credit, sponsor's going to support the company if it gets into trouble. So you've seen that more in the middle market than what I would like to see.
In terms of the covenant packages, how much do they help lenders kind of manage periods of stress? And, um, you know, ultimately, do you think, you've referenced it a little bit, has the push for loosening covenants gone a bit too far industry wide?
Mm. Well, I think we'll see, right? We'll see if the push has gone too far. As I've alluded to earlier, the purpose of covenants is not necessarily to be a gotcha. It's meant to be, let's be at the table and talk about it before there's too much value destroyed. If covenants have been loosened, so far that lots of value has been destroyed before you're at the table, and then the sponsor decides that they're no longer going to support the company, so here you go, the company's yours, you've lost that value as a senior debt holder. Now, the argument is, well, when I underwrote it, I had a 50% equity cushion. So I'm hoping that I've only lost 25% of it, right? But a distressed name, right? Once you've lost 25 and once it gets in the market that they've turned the keys over, all of a sudden you've lost more value there, right? Because obviously there's a reason why there's opportunistic funds out there, right? And that's who they're targeting, right? They're targeting those types of companies. So I think we'll see in the cycle that I talk about, like, have they gone too far? I think a lot of covenants have gotten to the part of where a covenant doesn't go off, but there's a liquidity crunch, and that should never be the case. And so I think direct lenders are thinking about it that way, going, okay, we've got to set the covenant such that, it's got to go off before there's a liquidity issue, or we've got to make sure that the sponsor can support it on that. Covenants matter, not only for value destruction, but it also allows you to reprice your risk. So if you underwrite a company at a certain spread profile because you thought it was this type of risk, right? Single B plus, we'll call it. But because of performance is migrated down to single B or single B minus, you can add to that spread because there's a covenant violation. And so you can change your risk, your risk reward by adjusting that. That allows you to get more money back, right? Before you get to maybe the end of the road with a company. You can start collecting. And remember, this is where people are thinking, like, in direct lending and senior secured debt, right? Your goal, right, is not to lose money, right? Let's get the principal back. And you can get that back in a variety of ways, right? You get the principal back through your original issue discount, so your OID, your fees up front. You get it back through your interest payments, and you get it back through principal reduction. If you have a company, if you hold it long enough, right, and even if the company doesn't survive, you could probably still get at least one times MOIC. And that's the key is investors, they may not get that, 10% return or 9% return, but they're going to get, because of those two that you got a MOIC below one, or three that you got a MOIC below one, now you're going to get an 8.89% return. Because again, it's about diversification of the portfolio. So that's where covenants really play a role. It helps you kind of to get value off the table and take money off the table in a time when the risk is higher in a company.
And 8.5 sounds a lot better than 0 or significantly less. So
right. I mean, that's where you gotta you look at it and people get so nervous about, oh my gosh, we're gonna get 0. Like, you're not gonna get 0 back, right? You're not gonna get 0 back. It's a diversified portfolio, and you kind of, you can lose the forest through the trees, or even like you're looking at the leaves because you're so into it, right? I mean, when you hear about stress in the private credit world, remember, this is a 1.5%, 2% holding in a big portfolio. And you've already taken some money off the table because you've gotten your interest payments during that time. So the odds of getting a 0 are very low on a senior secured basis. You can get it in other asset classes that are promising you, higher returns because you're taking on more risk.
So if we look forward a little bit, in terms of where the market is headed, as someone who obviously has been in the market a while. What excites you most about where this is heading?
We talked about it kind of a lot, so I'm going to sound like a broken record, but I look for the day of when, you know, direct lending and private credit is becoming more normalized on the balance sheets of privately held businesses. Because I think that is, that is going to be great. Capital is a good thing, and having access to capital is a good thing. And, commercial banks definitely have a reason to exist and should exist. But there are times when sometimes you need an alternative type of capital to come in. And I really think that direct lending can provide that plug that's needed in the balance sheet temporarily. So I look forward to the day of seeing it more in that space. I think it's got a long way to run, right? There's still a lot of dry powder in the private equity in the sponsor world. And then you've got your white space in the non-sponsor world. So even though there's a lot of capital out there, I think there's a lot to put, there's a lot of reason that capital will be put to work, and you'll be able to get some pretty good returns for, again, I highlight senior secured debt, top of the cap stack.
What's one thing LPs believe today about private credit that you think they'll view differently in the future?
LPs, that's interesting. I would say that right now, and I'm going to say private credit, I'm going to talk about direct lending specifically. I think a lot of LPs think of it as a beta play. So they really think of it as, I'm just going to put my money there and I'm going to get my return, and it's beta. And people can't outperform one another. It's going to be all bunched together. I think in the future, that's going to change. And they're going to see that there are some strategies and some managers that will outperform. So that's where I think you'll see the change on the LP side.
So we have just a few minutes left. I always like to end with a few fun questions. A favorite sports team and or hobby?
Michigan State basketball. Izzo is the best. No one wants to play Izzo in March. So,
but one follow-up to that is, I believe he's only won one championship.
I know. But, so he's the killer, right?
He feels better. Like his record feels better than ultimately the championships have shown. Because I watch college basketball, and I usually pick at Michigan State always to go pretty far in the brackets. But it feels like he's won more.
Well, you know what? Keep picking it, because we're due. We're due. So you can't. And again, I just love being the spoiler. I have a shirt that I wear during a March Madness party that we host, and it has January, February, Izzo. But people have joked, why isn't Izzo in April? So I'm like, that's a good point.
Yeah.
So, come on, Tom, let's go.
One surprising thing about yourself.
Let's see. I have a blended family. I raised 5 kids. And I have, my youngest are twins, and you can't see me, I'm 5'3". They were 5'8", 5'9", and 6 foot. And both of them played D1 sports. One played ice hockey and one played volleyball. So people would be very surprised to say that I had 2 D1 athletes, including those that played defense in hockey and middle for volleyball. Yeah.
One book that you'd recommend reading?
All right, 2. Because I got to do, right.
Two's better than one.
Business, smartest guys in the room. That's a call out to first brands and off balance sheet financing and how that can take down a company. So 1, 2, how to raise an adult. Love that book. Read it. It's a great book for those that have kind of kids that are 5 to high schoolers.
Well, I have a 3-year-old and a 7-year-old, so
I'll send it to you.
There you go. Most exciting part of your job. Is there anything obviously we talked about the excitement of the market, but day to day, what's the most exciting part of your job?
Yeah. Other than talking to you, Todd, it really is. It's talking to those founder-owned businesses, to the privately held businesses, like just learning about the businesses, learning how they created it. I mean, I get a lot of energy from that. I think I mentioned on our first call when I talked about Wisconsin, like I had 208,000 miles on my car because I drove around Wisconsin. And you meet just all different types of people that have really built these amazing companies, and they're everywhere from a small company to a really large company. And being a part of that and being kind of financial partner to them and helping them achieve their strategic goals and for the communities that they're in is I would say it's cool, right? But I'll say, more to the Z's or the alphas, like it's giving. It's giving.
And then final question, one prediction for the next 12 months.
I think the anxiety that's being experienced in, we'll call it the knowledge workforce and the urban workforce about AI is going to lessen as people start to see that this is not an existential threat to their jobs. And so they're going to move from fearing that it's going to replace them to having the fear of, wait a minute, how do I use this to keep up in the marketplace? So I think as the adoption curve increases, and if you look at adoption curves of new technology or just new inventions over the years, right? You start out a long time, electricity was like 40, 50 years to adopt that. The internet was like 20 years. AI, the prediction is, 5 to 7 years, 7 to 9 years, and it started in 22. So when it was first came out. So I think as the adoption curve happens, especially within the kind of the knowledge workforce, the anxiety will decrease in the next year, and they'll start to embrace it and utilize it more in their daily and say, hey, this isn't a bad thing.
I think that's a good place to end it. Dianna, thank you very much. I really appreciate your time and wish you and the team continued success.
Thanks, Todd.
Yep, thank you. Thank you for listening to the Credit Clubhouse podcast. Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.